Hello and good evening. Welcome to the Group Incorporated's annual real estate for 2022. We're grateful that you've tuned in. And for those of you watching at home, thanks for trusting us to provide you with insights and information about the Northern Colorado real estate market. For those of you who are watching this after the fact, also thanks for tuning in. While we would love to be in person this year, out of an abundance of caution for people's safety and their health, we decided to do this event virtually, but we're looking forward to getting back in person in front of you all very soon, and we wish you the best and happy health. So this year, obviously, we've got a lot to showcase and share. We're going to start off tonight by sharing with you the outcome and the output of our 2021 real estate markets here in Northern Colorado. We're also going to talk about our top stories shaping the future and 2022 markets. And then we're going to do things like look at our Boulder Benchmark, something that many of you know, but we'll look at a comparative property across Greeley, Fort Collins, and Boulder, Colorado to look at those pricing trends over time. And we've got a very special guest, Elizabeth Garner, the state demographer, is here to share us all the insights about Colorado, population growth, and including our counties up here in Northern Colorado. So let's take a look here at some of our 2021 results. So to familiarize you with the data here, we're looking at the different areas as you can see across this chart for Fort Collins, Loveland, Windsor, Severance, and Greeley and Evans. The left-hand or the darker blue column represents the combined median price of both attached and detached properties. The right-hand column is detached only, and then the little circles above represents the percent change year over year. So I'll go through these and highlight some of them. I'm going to primarily focus on the combined price, but I'll also talk about the detached in certain select markets. So let's take a look at Fort Collins. Fort Collins ended the year with a combined median price of $479,000. That was up 14.3% year over year. Loveland ended up at $433,239. That was up 12.6% year over year. Windsor and Severance, $473,703, represented a just shy of 17% increase year over year. And then Greeley and Evans, $360,000, up 14.4% year over year. What you notice is all of these markets had double-digit increases in the median price, and that held consistent for most of Northern Colorado. Let's now take a look at Timnath, Colorado. $573,615, which was up just shy of 13%. Wellington, $422,203, up 14% year over year. Berthoud, $515,000 combined median price, which was up 15.6% year over year. Johnstown at $460,000, up 15.9% year over year. Now we've broken out certain areas, and typically we do this when we get enough of a statistical basis to break them out. This year we've broken out Meade and Milliken, which has seen a heavy influx of new developments and new construction, and we'll continue to do this as areas grow. Meade has a median price combined of $497,940, just shy of the $500,000 mark, and that was up 10.3% year over year. Milliken, a hotbed of new construction activity, $411,000, up 17.5% year over year. And then going further down south, taking a look at the Longmont market. Longmont had a combined price of $520,000, which was up 15.6%. A detached price of $555,000, which was up 15.6%. And then let's take a look at Boulder. This one usually gets a few gasps from people. Boulder combined was $865,000, which was up just shy of 14%. And take a look at that detached median price of $1.256 million, which was the highest performer out of all markets, up nearly 30% year over year for detached properties in Boulder. Now let's look at Alt, Eaton, Kersey, and LaSalle, some areas that we have lumped together. And you look at this 376,061, and you say, wow, Alt, Eaton, Kersey, and LaSalle actually went down. I want to explain here that there was an influx of new attached product by some new builders, and that actually held that level down, which brought some affordable options out there in the Alt, Eaton, Kersey, and LaSalle marketplaces. And then looking at Estes Park, which is traditionally thought of as a second home market for many. I think it's gotten a lot of attention post-pandemic as people looked for ways, sitting right at the foot of Rocky Mountain National Park. $625,000 for the combined median price, which was up 24.4% year over year. And then the detached up 26.5% at $739,500. So Estes Park, really a market of interest for a lot of people looking for some outdoor exploration, a second home, maybe a vacation home. So let's now look at our real estate forecast and how we did at projecting home sales across the region. So every year we use the enormous intelligence and expertise of our group partners to try to forecast whether we're going to see growth, how much growth, and what those markets look like. In 2021, so last year, we predicted that we would sell 12,226 homes in northern Colorado. Now keep in mind, this excludes Longmont and Boulder, but encompasses all the other communities I mentioned previously. And in 2021, we were actually very conservative, but the actual number was 13,148, which brought our accuracy in at about 93% in predicting. We obviously thought last year we'd see a little bit different rate environment, but as the pandemic has gone, there's been a lot of surprises along the way, but growth has continued in northern Colorado, and we actually project that growth to continue into 2022, which we'll talk about tonight. But looking at our forecast for northern Colorado home sales, up to 13,500 for the 2022 year. We'll come back and see how we did next year, hopefully in person. So now let's look at our median price forecasts. So this year we actually did make a statistical change. We moved from average price, which we had reported in years past, to median price. So we didn't feel like it was very fair to go and look at our assessment. So what we've done is we've taken our 2022 forecast for median price for each one of these areas. So we're projecting Fort Collins to come in at $550,000 to end the year, Loveland at $480,000, Windsor and Severance up to $525,000, Greeley and Evans eclipsing the $400,000 mark, Timnath at $640,000, and Wellington at $455,000. Berthoud up to $580,000, Johnstown $485,000, Longmont to $600,000, Boulder combined price to $940,000, and then the Alt-Eaton, Kersey, and LaSalle market up to $405,000. So stay tuned and see how we did next year and come and visit us here at the forecast. But obviously a lot of growth. Nationally, a lot of economists and pundits are projecting a little bit of a slowdown in the market, more moderated of about a 5% growth in overall prices across the country. Based on the factors and the stories I'm going to tell you about tonight, we're actually projecting higher median price increases in northern Colorado, some markets in the double digits, but across the region on average more in about the 8% range growth year over year. But of course that varies by market and different conditions. So let's talk about appreciation. Many times people get appreciation and median price growth confused. And to help illustrate this, the Federal Housing Finance Agency basically takes data by reviewing a single home, and they look at many different homes in their statistical set, but they follow the lifeline of that home, and they look at every single piece of refinance activity. They review the appraised value upon refinance, and then upon any sale of that property, they record that data. And based on their data set, they go and look at that and come up with a statistical appreciation for areas. What you're looking at here is the Fort Collins and Loveland MSA, and this data goes back to 1978. The thing that I want to point out here is on the far side of your column here, this is only 3/4 of data for 2021, but the appreciation rate came in at 14.4% for Fort Collins Loveland MSA, and that is the 4th highest ever in history, and this doesn't include the 4th quarter data. As reference, the average over that same time period has been 5.4% appreciation, but I might suspect once we get the data in February for the 4th quarter that this will be the 2nd highest appreciating market for Fort Collins and Loveland since records have been kept by the Federal Housing Finance Agency. Let's take a look at Greeley. So this data goes back to 1984. Same holds true here. The statistical average over that time period from 1984 to 2020 is 4.7% appreciation. Just through 3 quarters without accounting for that fourth quarter, this is the highest appreciation rate that Greeley has experienced since the records have been kept. So let's now shift and let's talk about some of our top stories shaping the markets in northern Colorado for 2022. So first off, I want to talk about the no inventory myth. So you've heard it in the media, you've heard it across the board, and many of you have probably said it, man, there just is no inventory of homes. There's nothing to buy. I don't see as many signs in my neighborhood. There's just no inventory. And I want to tell you that's just simply not true. But we need to change our perceptions of what the marketplace looks like. And in order to illustrate this, many of you who go to the grocery store and shop can attest to this. Many of you who are watching that may not do your grocery shopping, congrats to you. I got to figure out how to do that. But you're looking at the pasta aisle here. And essentially, you're used to seeing full store shelves when you go to the grocery store. Much like the housing market, many consumers go into the housing market by looking at properties online, selecting the ones and narrowing it down to the few that they want to actually go out and see in person. They go and take the time and find the property that meets their needs and ultimately work with a real estate professional to put in an offer and secure that house. Well, the market looks very different today, and the way that consumers are having to interact with it looks very different as well. So to talk about the no inventory myth, I think you've got to look at some of the statistical data to showcase why there is inventory. So this is the national existing home sales rate from 1970 to 2021. In the United States, we ended the year selling 6.1 million homes. That's the highest on record since 2006. So since really right at the cusp of the Great Recession. And so it would be really impossible if we didn't have inventory to be able to sell the highest number of homes since 2006. Let's look at this more locally. So looking at our annual closed sales, so this is based here on the chart on the left is obviously 2019, the middle is 2020, and the right is 2021. And this is comparing the annual closed sales for Windsor, Loveland, and Fort Collins. So in 2021, Windsor had closed sales of 1,577 homes, which was up 25.8%. Loveland, 2,206 homes closed, up 5.3%. And then Fort Collins, 3,420 homes, up 3.3%. I've also put down along the bottom of the chart here the average month of supply for each one of those areas. So if you go back to 2019, each of those markets had more than 2 months supply of properties on the market. And in 2020, that obviously supply got a little bit lighter, going down to about 1.5 for both Loveland and Fort Collins. But then you look at 2021 and Windsor, less than a month worth of supply. Loveland, half a month or 15 days worth of supply of houses on the market. And then Fort Collins at 0.6 months. What this story tells is the velocity of the market is something that we haven't seen. So homes are selling, they're just selling at a rate that we are not accustomed to or have ever seen before. And really the way to describe this is, it's not that there's no inventory, it's that there's no standing inventory. When you go to the pasta shelf today in the grocery store, it looks very similar to like this. Now, I'm not an expert on pasta sales, so I don't know if they're selling more pasta today, but I do know that more houses are selling than have previously, which means that there is inventory. And this really emphasizes the point of what I believe is having a trusted advisor in your corner. Now, it takes somebody that understands the market and can help break the logjam of finding opportunities in a marketplace that many people may not see. There's amazing real estate professionals out there who have worked with customers who may know of people that are interested in selling, but the logjam has really tied a lot of things up. And I think it's caused a lot of consumers to believe there isn't any houses, I'm just going to step back to the sideline. But all while that's happening, median prices and affordability continue to get out of reach from some people. The next story that I want to talk about is one that I think is very important and has been a long-standing topic in northern Colorado, but I think elements of it are coming to the forefront, and that's water wars. The importance of water in the southwestern United States and Colorado's role in supplying water all across the country has really come front and center, and it's impacting real estate prices and really all of the supply and demand economics affecting our region. So I want to talk about water and some of the infrastructure projects and really how they impact us and what the future holds. So the first one that I want to talk about is the Chimney Hollow Reservoir Project. Many of you at home may be saying, I've never heard of it, I don't really know much about it, so let me give you some information. This is a Windy Gap firming project. Windy Gap is a project that is on the western slope of the Colorado River Basin, and essentially it sends water back through the Adams Tunnel, which runs underneath Rocky Mountain National Park, back into the CBT, or the Colorado Big Thompson Water Project. And it's to secure watershed for a lot of the municipalities, cities, and towns and water districts across northern Colorado and central Colorado. And this project started in 2003, which is the Chimney Hollow Reservoir Project, and that was to firm up the water yields to make sure that the water was coming across through the Adams Tunnel. This reservoir started construction this last year. You can see on the image on your left, dirt has actually started to move. And this reservoir, which lies directly west of Carter Lake, which you can see on the image on the right, services watershed for 12 communities and water districts. The reservoir holds 90,000 acre-feet water storage once it is finalized and complete, and then will serve about 30,000 acre-feet of water per year. The point I want to get across is some of these projects, being 20-year projects, are really infrastructure that are meeting the demands of where we are now or have been, but much like a lot of infrastructure across northern Colorado, we're trying to catch up while the growth continues to come. You know, I-25 is a perfect example of a lot of the I-25 construction and expansion. It's probably well overdue, and I just want to thank the efforts of a lot of the municipalities, the Chamber of Commerce's, and a lot of those initiatives that have put focus on these to help have sustainable growth. The next one. Now, a lot of these, I'm not going to get into the political aspects of the environmental aspects, but I want to talk about these from the impact of overall supply and demand economics and pressure on housing prices and how it affects you as consumers and homeowners. The Northern Integrated Supply Project, or as it's commonly referred to as NISP. This project began in 2004, and this is a large $1.1 billion project to essentially develop two reservoirs in northern Colorado. The reservoir, being Glade Reservoir, is 170,000 acre-foot storage that essentially, for concept of size here, the Horsetooth Reservoir is 150,000 acre-feet of storage. And a secondary reservoir called Gailton at 45,600 acre-feet of storage. The proposed site of that, as you can see on the image on your left, some of you may recognize this, but it's just a little bit north of the intersection of Highway 14 and Highway 287. Actually, stretches of Highway 287, about 8 miles, would need to be relocated if the NISP project goes forward. This project would supply water for roughly 80,000 families, and as we've seen the demands on population growth and projected population growth, which I'm sure we're going to learn a little bit more from the state demographer, this will have a major impact. Now, whether this project goes all the way through, it's got a lot of hurdles to go through, but it will impact, whether it happens or doesn't happen, the overall economics in northern Colorado. Looking at the projected timeline of NISP, this is a project that's been going on for a long time, so kind of out of sight, out of mind. But where they sit is they're waiting on the final record of decision from the U.S. Army Corps of Engineers, and that is anticipated any time. As you see on this timeline, it's projected for 2022. But to tell you how long these infrastructure projects take, really the first water wouldn't even be stored into Glade Reservoir until 2028. So finding water and municipalities trying to secure water is a big factor in where development and growth goes. Another thing that recently has happened is Nebraska coming for water. So early January of this year, the governor of Nebraska basically said they are going to launch a $500 million plan to claim water that is part of a South Platte River Compact. It's a 99-year-old agreement, but Nebraska is concerned about the number of developments and potential water projects along the South Platte, and they're looking to come for portions of water that they have been, what they claim is due to them. So a big legal fight over water with the state of Nebraska. But the other thing I want to point out is, a lot of these Denver growth communities are also thirsty. We've seen the Thornton pipeline. We've seen Aurora come up north and spend big dollars to try to acquire water from northern Colorado, and these will have major impact. Currently on the surface here in northern Colorado, we have moratoriums on water taps in communities like Severance, where development is ready to go, but moratoriums on these water taps are preventing those developments from moving forward and further constraining new construction, which will obviously have impacts on the availability of housing in northern Colorado, putting further pressure on prices. So let's talk about development and specifically new construction and the dynamic development, because everything is changing so quickly. The home building puzzle has never been more complex. Builders are facing challenges. Today, builders are having to become developers, and they're having to secure land and lot opportunities for them to develop these projects so that they can secure and viable business for them moving forward. They're facing extreme labor shortages and reliability issues with labor, as many people have seen these constraints. But really, new construction has been constrained for a long time with a lack of skilled labor. Most people are choosing jobs based on technological acumen and really a lack of people interested in skilled labor. And then with all of these shortages, it's putting certain pressure on builders. Dynamic supply chain alterations, so things like cabinets, appliances, which I'll show you here in a second, are also having major impact on timelines of delivering new construction product to the marketplace. Managing costs. Last year we talked extensively about the cost of lumber and its volatility. And this year we're seeing, to start the year, the cost of lumber start to spike again. Those are posing challenges. Municipality management, so going through the permitting process and the entitlement process, a lot of these smaller communities don't have the resources. They're impacted by the pandemic and by COVID, of having worker outage and things getting backlogged and not being able to move through as quickly. Most builders and developers are choosing communities and where growth occurs based off of two primary factors. One, water security, and two, are they metro district friendly? And based on that, I will tell you, moving forward, the epicenter of growth seems to be centered around Highway 34 between Greeley, Windsor, and Johnstown. That area is going to take front and center because, Greeley has done an amazing job of securing long-term water, and a lot of developers are obviously looking to that area, and so we see that as being a very big bright spot of growth moving on to the future. So let's talk about disruptions to new construction. This research comes from our good friends at Zonda Research and John Covert, but this is builders reporting in their own survey of what disruptions will continue into 2022. Government services, so like I said, these municipalities, 62% of builders said that this would pose disruptions into 2022. 90% said yes, that supply chain disruptions will be a problem this year, whether it be lumber, appliances, windows, or doors. Labor shortages, this is up from 69%. At the end of the year, this became even more prevalent. So 82% said there will be disruptions continuing into this year with labor shortages. And then land disruptions. The volume at which builders have sold off new construction, 54% said land disruptions will be an issue. looking at the percent that are reporting serious shortages by what materials. And this is stretching timelines, as I said. So projects that normally would take somewhere in the neighborhood of 6 to 8 months are now taking 7 to 12 months to complete. And so really elongating those timelines for builders developing and bringing new construction to the market. 60% said windows and doors will be serious shortages this year. 35% said garage doors. HVAC at 29%. Cabinets, trusses, millwork, copper wiring, steel, framing nails, all of those things, and it's dynamic. One week it's one thing, the next week it's another, and so they're facing major challenges with being able to get reliable product, supply, and labor. Let's look at the vacant developed lots inventory in northern Colorado, because I said the velocity of the market for new construction was something many of them had never seen, and it was basically offering an outlet or relief for the residential resale market, as many consumers chose new construction to not enter in or step onto the highway or freeway that has been the competitive resale market. Larimer County has 1,905 vacant developed lots. That's down 23% for the last 12 months, and it's at historic lows. Weld, 2,431 vacant developed lots. That's down 34% in just the last 8 months, as builders absorbed a lot of those lots that they had on heavy demand. The next story I want to talk about is the Great Resignation. There's so much has been made about workforce changes and workforce shifting and employees leaving jobs. And really, I think a better term is the Great Churn. The Great Churn continues. In November of 2021, we set another record of 4.5 million non-farm workers voluntarily leaving their job to go look for other jobs or even not entering the workforce at all. And this is having major impact on employers, and those major impacts pass through across the board. So employers are faced with challenging decisions of basically increasing wages. Do I outsource and find remote work and potentially allow a hybrid work environment, maybe in lower cost of living to reduce overhead? Because all of those costs of increased wages pass through in some way in goods and services, much to do with the inflationary conversation in the economy today. But one of the things that I don't think has been experienced yet that needs to be on the radar of both employers, but also the public at large, is the delayed rental rate increases that we'll probably see and experience and are seeing and experiencing in northern Colorado. Now, why are these delayed? Well, last year at this time, we still had in place eviction moratoriums. Many landlords and owners and project owners were very concerned about the viability of their tenants to be able to pay with economic uncertainty. Many kept rental rates stable. But as the cost of goods and services have passed on to them, of simple ability of getting cleaning people to getting supplies, whether it be touching up, refreshing paint or carpet, all of those costs have continued to grow, and that has passed through based on heavy demand as well to consumers. At the end of the year, we had the Marshall Fire, a very tragic and unfortunate event where over 1,000 homes were lost down south. Well, many of those people have been looking for temporary housing. That puts additional pressure on the marketplace with really not a lot of supply, and supply being absorbed quickly. Additional demand on the marketplace puts pressure northward on rental rates. We're already seeing them in northern Colorado increase by 7 to 15%. And that's something that isn't accounted for by a lot of people with already some of the inflationary pressures and the cost of housing that we're already seeing. But all of this demand is because people want to live here. People are very interested in northern Colorado and what it has to offer. So let's look at our recovery, and we've always said employment is a big factor, and we're looking at the number of employed by county. This is a big factor in the health of the overall real estate market, and usually is a 12 to 18 month predictor of what we can expect. So Larimer County hit a high water mark of 207,000 employed in November 2019. And then with the shutdown that came as a result of the pandemic, 13.7% of those employed were lost, down to 178,000. As the pandemic has gone, so has some of the employment fluctuations. But we're just shy of 200,000 and have recovered nicely in Larimer County, up 11.1% since that drop. Let's look at Weld County. 169,903 employed in November of 2019, with a low mark down 12.8% to 148,000 during the shutdown. Has recovered well at 10.4% back to just shy of 165,000 employed in Weld County. Boulder County has really recouped well since the shutdown. 194,571 as the high water mark for employed, and down to 174,179 in the shutdown, and has recouped 10.3% of that, all the way back up almost to flush at 193,000. So the economies have rebounded very well. Really these impacts have been felt in certain sections and sectors of the economy and the number of employed. But the outlook and everything looks really great for Northern Colorado from the standpoint of jobs, job recovery, and overall health. For this next story, I'm going to bring up a good friend, and there's a lot more interest in rates. And I'm going to bring up Jason Peifer, the president of Group Mortgage, to talk a little bit more about why there's more interest in rates.
Thanks, Brandon. Good evening. There is more interest in rates these days, it seems, because there is more interest in rates. So if we look to start at the forecast across the industry, we can see whether it be the National Association of Realtors, National Home Builders, Mortgage Bankers Association, every one of them is seeing rates move up. The consensus is about 3.7%. And these economists have to be some of the best in the nation, because although we're only about a month into the year, their forecast is already correct and right on. We've seen interest rates over this time move up about 0.5 to 0.75%. This was last updated about a week ago. We've continued to see pressure on that. And I don't want to be overly dramatic about 0.5 to 0.75% increase to rates. But if we look at last year, that's twice the volatility that we saw all of that time. So what's driving up the interest rates? Well, the first thing is, last year I discussed, if you want to see what's going to happen to interest rates, look at what the Fed's doing. And towards the end of last year, the Fed announced that they were going to start tapering their mortgage-backed security purchases, and likely in that program by March. They started doing that, and that's put considerable upward pressure on interest rates. There's also, as Brandon talked about, the inflationary pressures that are out there. Right now we're at some 40-year highs as far as those numbers go. And if you think about an investor that's maybe getting 3 or 4% on their bond, and if inflation's at 5%, their real rate is negative 1%. So that's going to continue to put some upward pressure on rates. However, if we think about the interest rates over a more long-term perspective, they're much more accommodative. So I'm not talking about interest rates in a comparison back to the 80s. If we just look at the rates over the past 5 years, we still are kind of in the middle of that range. And I think there's several factors that are in play this year that will kind of keep a ceiling on just how far the interest rates go. The first one is the less supply of mortgage-backed securities. Refinance transactions are already down about 50%, and they'll continue to move lower as far as rates increase. So with less mortgage-backed securities hitting the market, that should taper the increases to those rates. Inflation moderating. If you listen to the federal chairman report today, he was talking about how inflation is persistently high right now, but it is something that they expect throughout the year to moderate. So we'll look for that and continue to monitor that, because likely as inflation keeps high, that will keep upward pressure on rates. Excess capacity in mortgage origination. We saw so many mortgage companies out there ramp up their staffing and everything to help out everybody looking to refinance and buy homes over the past several years. Well, now that some of that volume is pulled back, we're all competing for your business and trying to earn your business. What that ends is a margin compression and ultimately lower rates to the consumer. Lastly is the Federal Reserve. We started with the Federal Reserve and we kind of end with the Federal Reserve. And so if we think about what happened during the Great Recession, is I think the Fed learned that housing is so critical to the overall broader economy. And so although they might be pushing rates up right now in order to stifle inflation, they're going to be watching housing all along. And if those higher rates start to impact the housing market, I think it's very likely that they'll utilize their power in order to support the housing so the broader economy isn't impacted. Before I leave, I also wanted to talk about something that we followed for quite a while here. Just a few years ago, we were looking at a conforming loan limit of about under $425,000, and that has marched up all the way to almost $650,000 as prices go up. So not only are the conforming loan limits moving up, but also the equity homeowners have right now has moved up, and it's a concept that Brandon and I talk quite a bit about called your tappable equity. So your tappable equity is basically your overall home value, 80% of that, less what you owe. And that's moving to some historical levels that we've seen.
Yeah, and I think I've got a question for you, Jason, that we've talked about is, as a lot of economists and forecasters are predicting that the rising interest rate environment potentially presents a slowdown for housing. But what's the offset here of, and what's the tolerance of homeowners that have seen, substantial gains in equity willing to tolerate some of the rate increases to continue to move around?
Right. So I think they bring up a good point that there will be a headwind there. As you have higher prices, higher interest rate, your mortgage payment's higher. And so that will be a headwind that we face this year. However, with the tappable equity, as somebody's looking to sell their home, they have more proceeds. And we already saw some of this in 21 and throughout the year, where somebody would have those proceeds, and rather than just taking all of that and applying to the down payment, what they can do is they can pay off their credit cards, pay off an auto loan. So although their home payment might be more, you look at their overall financial monthly obligation and it is actually less. So I think as you see in Colorado where you have $78,000 more tappable equity than you did a year ago, that's going to help real estate moving into the other year. And also when we look at the overall picture, cost or the price of your mortgage payment, that's one aspect of the buying decision. There's other really strong factors that are in play here. You look at people's confidence in the housing industry. You look at their security in employment and their prospect for wage growth. Those will impact it as well. And you look at people wanting spaces that fit their new lifestyle. I think all those items make 22 a promising year.
Awesome. Well, thank you so much for the insights. I really appreciate
Thank
it. All right. So let's jump on to our next story. And this one's a fun one, the Boulder Benchmark. So again, like I said, we benchmark a property. This is a Wheeler Construction home. And Wheeler Construction built the same home during the same period of time in Greeley, Fort Collins, and Boulder. And this comparison gives us really a track record, and we've done this for many years, to follow the trend of what has happened with prices in each one of those markets. So let's take a look here at our benchmark properties for 2021. So the first one I want to showcase here is Greeley, Colorado, 2430 12th Avenue Court, 1,005 square feet. This sold on April 26th of 2021. I did this year for impact. I wanted to showcase this property was listed at $315,000. It ultimately sold at $336,000 or $334 a square foot. Now, much has been said about the competitive nature of the marketplace, multiple offers, having to write offers over asking price. And while, yes, that's true, you'll see that here, there also are properties that are out there that do indeed sell for less than asking price. But again, the market perception becomes reality for a lot of people. So Greeley at 336. Let's take a look at our Fort Collins property. This is 2220 Purdue Road. It's 875 square feet. It was sold on June 15th. It was listed at $474,900 and it sold for $470,000, a per square foot price of $537. Now let's go to Boulder. Boulder, Colorado, the Boulder Benchmark, 4205 Martin Drive. This property is 1,387 square feet, sold on July 6th. Now this one is a wild one, listed at $740,000. It sold in 2 days for $865,000, so more than $100,000 over list price at $624 a square foot. So looking at the trend line here of how we've tracked, Fort Collins being just shy of that $500,000 mark, Boulder now at the $865,000, but Greeley actually catching ground on Fort Collins here up to $336,000 for our Wheeler construction comparison year-over-year trend. So very, very interesting data and very, continue to track right along. If you want to look and see where we might be here in 5 to 6 years, you got to look up at that Boulder line. You can see, I believe it was back in 2013 or really 2014. So not a few years, more than 8 years behind that trajectory of where Boulder is for prices here in northern Colorado. The next story I want to talk about here, and this is going to be a segue into Elizabeth Garner, and she'll have much greater data, is the Great Migration. So a lot has been said about this outflow or inflow of people. I think as you read the headlines through the pandemic, people are fleeing urban environments to move out into suburban environments. They're moving out of states like California or New York, and they're finding their way to better quality of life. Does the data support that? We're going to find out tonight. But the thing I do want to talk about that I think is a continuing trend that will impact all communities, including our northern Colorado communities, is the basis of why movement is happening. So what you're looking at here is the wealth movement and migration, and this is from 1992 to 2019. So this doesn't encompass the last 2 years, but you see that wealth moved across the country, and in a lot of reasons, people are moving that wealth and making decisions based on where they live off of these key factors. Tax, income tax, or property taxes play a big role in some of the migration patterns. A lot about political ideology and why people are making decisions to move based on politics. Quality of life, something that we've put northern Colorado on a pedestal, and many other people have, that they move here for the quality of life, the ability to get outdoors, to work and play in the same environments. Safety. So yes, much has been made about the quality and of safety. Do people feel safe in their communities? The business environment. We've seen this play out on a national scale with so many companies, leaving to epicenters like Austin, Texas, leaving Silicon Valley because of the business-friendly environment. Aging and retirement, something that I know we're going to learn a little bit more about tonight, but a lot of people aging and retiring and looking to go to warmer weather states or better living arrangements. And then cost of living, something that certainly can impact Colorado and its growth or its slowdown, is the overall cost of living. And so before I transition, I just want to say, northern Colorado, with all the things going on, yes, there are some challenges. Yes, there are some growing pains, but this continues to be a very vibrant and robust real estate market. The new construction challenges are going to put added additional pressure on the residential resale market that already is at historic lows, months of supply of inventory. The market's moving incredibly fast, and we see this next year not being any different, with prices continuing to grow, with demand continuing to be incredibly strong, even in the face of some of the economic uncertainty about interest rates or other things. So it's a great time to be a homeowner in northern Colorado, and your investments have been sound investments moving forward. So I'm really excited to bring up Elizabeth Garner, our state demographer, to tell us a little bit more about what's impacting the state and our counties.
Thank you again for having me here. Thank you, Brandon, for all of your really good information. I'm excited to look at all of the different pieces that you have for northern Colorado. So what I want to talk about today are actually some of these big trends, and Brandon hit a ton of them. But some of the things to be aware of. So one is that actually population is starting to slow down. We're starting to grow, but at a slowing rate. We're seeing that the fact that births are down and deaths are up pre-COVID, not COVID deaths. Migration and mobility is slowing, and so that's something for us to keep an eye on. And it's also because it's harder and harder to attract and retain the best and the brightest. Therefore, because migration is slowing, our labor force is slowing, and it kind of becomes this circular impact. Talk about that and the fact that if you think it's tight now, just wait, it gets even tighter. According to our forecasts, we're seeing a lot of concentrated growth along the I-25 corridor and for the Front Range area. And aging. How many of you guys woke up a day older today? This is something that's impacting everything. Brandon alluded to it a little bit, but this is the biggest transition that Colorado is going to see in its history. Basically, since the baby boomers entered their life, this transitioning out of the labor force primarily is going to be a huge impact on the state and impact everything, including housing. So I'll be really referencing how it affects housing. And the fact that we're becoming more racially and ethnically diverse. So we're going to see in the state that basically our client base, our labor force, everyone is going to be a little bit more diverse, and that's going to be an important characteristic to look at as well. So finally, we got the Census 2020 numbers, and I thought I'd hit some of the key pieces. One, the U.S. grew. I think probably everybody was aware of that. We increased by about 22 million people. It was a 7% growth rate. But the most interesting takeaway is that it was the second slowest decade on record. The slowest was the Great Depression during the 1930s. Colorado also increased. We increased by about 744,000 people, an increase of 14%. So quick math, you can see twice as fast as the U.S. as a whole. We were sixth in terms of percentage change, ninth in terms of total change, and just enough for that 8th congressional seat and all of the drama that came with that. But maybe even more interesting is we recently received the estimates from 2020 to 2021. For the U.S. or for Colorado, we increased by 27,000 people. So anybody that follows trends would actually know that this is one of the slowest rates that we've seen between 2020 and 2021, in the middle of this pandemic, a 0.5 growth rate. Net migration slowed down to 14,000. We were 17th in terms of percentage growth, 11th in total growth in the United States. For the U.S., it was the slowest growth rate on record ever since they started gathering data, a 0.1 increase in terms of 0.1% increase. 17 states lost population. So when I'm talking about the fact that Colorado's slowing down, it's actually also because the United States is slowing down. It's not necessarily because Colorado is any different, although you'll see that our ranking definitely had an impact. But if we look back and just look at 2010 to 2020, all of the red, orange, yellow counties were counties that grew in population. All of the shades of blue declined. Within that 16 counties that declined, it was about 7,200 people. So it's not a gazillion people fleeing from rural Colorado. And actually, this is very similar to historical trends. What is different, though, is that 95% of Colorado's growth was along the I-25 corridor, along the Front Range. And it was very, very concentrated. This is different from historical trends, where last decade 78% of our growth was along the Front Range. You'll see in there that both Weld and Larimer are in that top 10 for total change over the decade, as well as you'll see that some of the highest percentage growth in the state as well. So you'll see Weld there increasing by about 76,000, Larimer increasing by about 58,000, and you'll see those percentages faster than the state as a whole. So what creates population change? We've got three big pieces: births, deaths, and net migration. The blue component shows that natural increase, which is births minus deaths. You'll look at this over time. It starts in 1970, and you'll see some booms and busts, and definitely with that natural increase component, we reached our peak in 2007, and you can see that it's been slowing down ever since. The red piece is net migration, the ins minus the outs. So big takeaway and important messaging, and this is so important for, I think, media especially, is to look at the last 5-6 years. We reached a peak growth in 2015 and have been slowing ever since. We've been slowing pre-pandemic growth to Colorado. Yet a lot of times you hear from the media exponential growth and people flocking to the state. Now I understand in terms of selling things, you might want to be saying that, but it also scares people. And so we need to be able to balance the narrative to actually reality would be good, about growth, the fact that it's slowing, so that we're also looking at it with the right lens, that we don't scare local governments from like prohibiting growth, limiting growth, when really what we're doing is naturally slowing down. Really important. And also important to see that births are the largest component of total population change. Over 600,000 in births, about 362,000 in deaths, and about 445,000 in net migration. So important, again, to put a lot in context, but you'll see that natural increase is slowing down because we've seen births slow, and I want to talk about that a little bit. So we've seen births slowing in both the United States and in Colorado. We reached our peak birth for both in 2007. Colorado now has about 8,000 fewer births per year than we had in 2007, and the United States about 525,000 fewer births. What this means is that as we move along, fewer folks entering K-12, fewer folks entering higher ed, fewer folks entering the labor force. And then that means also fewer folks entering home buying or home renting. So important, again, I look long run. You guys probably care more about what's happening like this year, next year. I care about what's happening 20 and 30 years down the road. But important to know that this is a long-term big impact to the United States. And in fact, we can see that over the decade between 2010 and 2020, that there was a 1 million person decline in the under 18 population. All of the shades of blue states are states that declined in their under 18 population. So 27 states declined. This is important to Colorado for two big reasons. One, a lot of those states, like California, are big donor states to our population. When we migrate people to Colorado, a lot of them come from California. So that's seeing some downward pressure. Likewise, you can see the Northeast, Midwest also slowing down. So they're going to be ultra competitive for our labor force in the future. So again, like I said, we've seen this tightness in our labor force. Brandon talked about it. It is not stopping because that peak person that was born is 14 right now. So just a couple more years and then we'll have fewer and fewer people entering the labor force. If we look in Colorado, same idea, red, orange, yellow positive for the under 18. All of the shades of blue are counties that declined in their under 18 population over the decade. 43 of the 64 counties declined. There is no region in the state that avoided it. We can see the Southwest, we can see the mountains, the Northeast, all areas, and Denver Metro that also declined in that under 18 population. But you will be happy to hear that actually Weld had one of the largest increases in the under 18 population. They represented about 43% of the total growth in the under 18 population. So when I tell people about this, I'm like, so if you're looking for a labor force in the future, make sure you're really friendly with Weld because that's where all of the kids are. We only increased 38,000 in our under 18 population over the decade. So we increased by 744,000 as a total. The under 18 was 38,000 and represented only 5% of our total population change. So this really is a significant impact in Colorado. Larimer, another one that is in that top 10 in terms of growth, is an interesting one. It is the only county in the state, hear that, only county in the state that actually increased that under 18 population change over this decade. So this last decade, it increased by 5,600. The previous decade, it was like 4,200. Weld, even though it was the largest, actually this is a slowdown from the previous decade. So again, important context for understanding the future. So the other piece that I didn't talk about, net migration, and Brandon hit about it as well, kind of hinted at what's happening in terms of movement. First thing to understand is, who do we typically migrate to the state? We migrate young adults. So what did I just say is slowing down? So that is something for Colorado to be aware of, is the fact that we tend to attract 22 to 37. We're good for probably the next 10 years. It's the 10 years after that that I would start wondering, where are people going to be coming from? And even into this next decade, probably the second part of the decade. But both Larimer and Weld are kind of different than the state average. So that top graph on the right-hand side is Weld County. They tend to actually attract everyone. So fortunately for them, they diversified their migration base and can seem to almost attract anyone there. Larimer County, the second one, the one on the bottom, actually probably needs to keep a pretty good eye on what's going on as well. So they attract typically those young adults. You can see both counties have that college bump right at that college age. But then Larimer especially sees pretty slow migration after that, a little out after people finish school. So a couple of things to keep an eye on as we move out into the future. When we attract people to Colorado from other places, and again, Brandon hit on this, so I'm not going to spend a ton of time, where do we tend to attract people from? So all of the red, orange, yellow states are donor states. All of the shades of blue are actually receiver states. Those are states that are net receivers of Coloradoans. So we don't just gain from everywhere, we also lose, and we're seeing some loss to that northwest part of the country as well as our neighbors, which I think is very interesting as well. But our biggest donors ending up being kind of that California, Texas, Florida, Illinois, which is interesting to see. So on the right-hand side, I put some charts in showing where Larimer and Weld tend to get folks from. And I think maybe the biggest takeaway would be that our largest in to both of those counties tend to be from other counties in Colorado. So it doesn't tend to be a primary destination necessarily from out of state. It might be the second or third location that they end up in. So important to take away on both of those ends. So you can see some of the largest donors, except for Larimer definitely gets some California, Texas, and then the Alabama. Thought that was an interesting component. And then in Weld also gets a little taste from Arizona. But we do see an out-migration from Larimer and Weld to other places, and not just in Colorado, actually across the country. So kind of an interesting way to look at that migration component. Why do people move? Number one determinant tends to be job growth. And so that's why, obviously, in real estate, you guys keep an eye on job growth and new jobs. The other thing that you guys should be also taking an eye on, or being aware of, is now this next decade is looking at retirements, because retirements don't show up as a new job. So for example, I'll maybe, cross my fingers, age out of the labor force this next decade. I'm going to leave, not be the state demographer anymore. Somebody else is going to be hired into that position. That person coming into my job does not count as a new job. That's just refilling a job. We're forecasting about 500,000 people to age out of the labor force over this next decade. And those are also people to be keeping an eye on. They're either going to age in place, or they're going to maybe take their values that they've accumulated, according to Brandon, and they could then leave to a lower cost state, leaving room then for new people to come in and buy those homes. But important to see that a couple of points with this graph. One, we see this correlation between job growth and net migration. Second is right around that 2025 bar, which is the job growth, we're forecasting a pretty quick return to employment. Not only because we're doing pretty well, but also there's a lot of stimulus dollars out there, and that's going to be pushing some of this recovery. But then what you see after that, after kind of 2030, is a slowdown in job growth and a slowdown in net migration. Why? Because of labor, because of people. If there aren't, this is a good one, if there aren't people to fill a job, it doesn't actually count as a job. It only counts as a job if it's actually filled. And so it's important to understand that this balance, this kind of double edge, is that we see job growth, but job demand, but you actually have to have a person available to fill it to actually count it as a job. And so looking at this relationship is really critical in terms of understanding the future growth in Colorado and the North Front Range. I won't spend much time on this one at all, but this is just showing job growth by county in the Front Range. And I wanted to highlight that both Larimer and Weld were definitely pre-pandemic in that top 5 counties growing in the state in terms of job growth. We indexed everyone to 2005 and then saw that growth over that. We have both Douglas and Adams are kind of above that component, and then you see Broomfield is kind of in between there, between Larimer and Weld. Everybody lost jobs during the pandemic, and it's important to see how we're all recovering. But what are we forecasting for the state? Really, over these next 2 years, an increase of over 100,000 jobs in each year. So in 2021, we won't get those numbers for another 6 months. But then also in 2022, about another 112,000, again, driven by the stimulus dollars that are out there. But I also want you to see is pre-pandemic, Colorado was also starting to slow down. And I think a lot of that actually had to do with housing. Either a shortage in housing, but not like a technical economic shortage in housing, but enough so that it was putting so much price pressure on us that it put downward pressure on people being able to move to the state because it just wasn't affordable. In terms of recovery, where are we? Colorado's recovered about 85% in terms of what we lost during the Great Recession. U.S. is at about 82%, so we're doing a little bit better than the U.S., but we're ranked about 19th, so there's definitely a lot of other states that are doing better, and like our neighbor to the west, Utah, is like up at 103%, so they've already recovered all of the jobs lost. On that list, you can also see the different MSAs, and in this ranking, it both shows that Larimer and Weld are actually trailing other MSAs in the state in terms of that recovery. A lot of it has to do with the oil and gas industry in Weld County, and then kind of the leisure and hospitality industry with like Estes Park and other parts of Larimer County, driven in Larimer County. But benefit to see is that all counties and all MSAs are recovering from this pandemic recession. So let's talk about housing just a little bit, but you guys are obviously the experts in that area. One of the things I really wanted to talk about is housing and construction. What this chart looks like or looks at is housing growth annually, as well as household formation. So households are those that live in a house. Makes sense, but it's different than the concept of population because it's the grouping. So, the average 2.5 people per housing unit. Couple of things that you'll see is one, the importance of looking at long run. This starts in 1990, which isn't maybe long run enough. Maybe we start in 1970. But this gives you an idea of ebbs and flows of building construction. One of the things that we found with the Census 2020 data is that over this last decade, only 278,000 housing units were built, compared to the previous decade, where 404,000 or 405,000 housing units were built. So definitely a big slowdown. And it comes to bear because I was talking with folks the other day and they're like, oh my God, the housing boom. And I'm like, what housing boom? And they're like, no, all of the houses that are coming online. And I'm like, wait a minute, when did you start looking? Because if you go back to 2000, where we are right now, building about 40,000 housing units a year for the state as a whole is okay, but nowhere near where we were in the 2000s, where we were building 50 and 60,000 housing units a year. But this also shows the disequilibrium between the two, between housing unit construction as well as household formation. And this is really what has led to the tightness in the housing market, as well as the accelerated home price, which I'm going to suggest is also making Colorado a little bit less competitive. So looking at how do we bring more housing units online, I think is going to be critical to the state. And also, how do we do it, environmentally sound way, and also making sure that there's water available for those housing units. So I won't go into the supply issues because Brandon certainly covered all of those, but I will go into the demand side that I think is important from a demographic point of view. You already know this whole job growth equals population or equals demand for workers, and so that's going to drive demand for housing. Likewise, aging. So, and I can use myself as an example. We were a family of 4. Now we're a family of 2. Both kids have launched, and that same one house is only providing housing services for 2 people rather than 4. We've got a lot of people aging into older age groups, and that's going to change our demand for housing, is that really fewer people per housing unit. So that's going to change the demand. Millennials are also not just entering the home market, they're already in the prime home buying and actually aging into the prime second home ownership. So a lot of folks have been wondering what's going on in the mountain counties, and a lot of it is actually millennials who are aging into their 40s are aging into prime home buying and buying second homes. Gen Zs, if you can believe it, are already entering the home renting and home buying age groups. There's also more money out there. People didn't travel, and they also got a lot of stimulus dollars putting that demand for housing out there. The last one I'm going to bring up, because I want to know the answer, is I think that there's also some concern issues with institutional investors in housing. We know a lot of institutional investors are coming up and buying single-family homes, but not renting them. And I'm concerned about that factor. The other piece is also cannabis dollars. Because we don't have a stable banking system for the cannabis industry, we know that there's a lot of those industry folks that are taking those cash dollars and buying homes, and because they're not in, kind of managing home industry, they're in the cannabis industry, they're also leaving them vacant. And with all of the returns that Brandon was talking about, 16%, 20% annually, you don't need to. You can just hold those units available and are seeing that appreciation in your assets. Quickly want to talk about age and the fact that age impacts everything, and that's maybe the number one important variable for you all to keep an eye on. Because it impacts the types of housing, the value of housing, the size of housing, the location of housing that everyone is going to be needing, let alone the labor force component of actually trying to build these housing units. If we look, this is Colorado's age distribution broken down by single year of age and generation. The black line is at 65. Our peak person is 29 years old, 30 basically. You can see that slowdown in our population on that far left-hand side. Definitely fewer 0-year-olds than there are 60-year-olds. So this is going to put some slowdown in our population out through the future. You can also see the number of people aging into the 65 plus. A lot of people, a lot of boomers in that purple, aging into that 65 plus where they could be retiring, and they could be moving to join family in other locations. They could be downsizing, or they could be aging in place, like my mom. And I always make fun of her because I can, because I'm her daughter. But she was still in the house that I grew up in. It is 3,500 square feet, living alone, 5-bedroom. It should be accommodating 5 people. But it's her alone, and I call her a waste of housing resource. I can do it because I'm an economist and I'm her daughter, but we have to take that into account that this is happening within the state and having a big impact in different areas. So if we take that information, we look at who's growing over the next decade by year, we can see very flat growth in that 0 to 17, slight growth in the 18 to 24, a little bit of growth in the 25 to 44 if we can migrate them here. Again, that's an if. Very flat pretty much in the 45 to 64-year-olds. But where do we see most of our growth? In the 65 plus. And And when I share this table with a lot of people, they say, God, where are they all coming from, Elizabeth? I'm like, look in a mirror. They're coming from us. We're going to be celebrating birthdays and aging into that 65 plus. So it's not that we're a big net migrant. We're not like an Arizona or a Florida. We slightly positive. Larimer County, a little bit more than the state average. So important to see that of this increase of about 700,000 over the next decade, about 43% in that 65 plus. So thinking about that and how that might impact the real estate industry, I think is really important. And you could see, I'm going to list all of the different components that I think are out there. One, in terms of consumer demand. Two, in terms of labor force, and really trying to understand who's going to build these houses that we actually need. And it's going to be a major labor constraint. So looking at strategies for how do you get people into the industry earlier, how do you keep people in the industry later, are going to be really important things for us to look at. Likewise, again, as I'd mentioned before, in terms of that housing, even other types of housing services like remodeling and accessibility are going to be critical. Law also looking at services within a community. If a person cannot age in place, they are not going to stay there, and they're going to take those assets and potentially leave. So that's another factor to consider in different communities, and especially like Larimer and Weld, that haven't had necessarily a lot of older adults historically. Second to last piece that I'm going to talk about is really the diversity of our state and the fact that we're becoming more racially and ethnically diverse. Over the last decade, we increased our diversity index from 46 to 52. That just means that we're becoming more racially and ethnically diverse. If we look at the growth over the decade, again, we increased by 744,000. About a third of that growth, so 239,000 was in our white non-Hispanic, but 2/3 of our growth were actually in people of color. So that's going to be important to look at, and then understanding where that growth is taking place. And what we're seeing is it's actually really taking place in our youngest population, those that are moving and those that are being born. And in our under 18 population, we can see that there was actually an absolute decline in the white non-Hispanic, and all of the growth was in our people of color. So our youngins, those that are entering the labor force, entering our home buying age, are going to be more and more diverse. And it's going to be really, really important that we're making sure that we're looking through that lens when we're looking at marketing material, when we're trying to attract a labor force, when we're looking at educational opportunities, because this is really going to be a significant part of our future. And this chart just shows that our share of people of color are much stronger and much larger at our younger ages, basically under the age of 24, compared to, let's say, our 65 plus. So a pretty big transition within the state. I won't go over this big, I won't go over that. You've got it now, you can see it, you can read it yourself, but the importance of making sure that we're looking at diversity within Colorado. So what is our forecast for the state? As I've mentioned before a couple of times, we're forecasting births to slow. Slow any further than they are now? I hope not. But we are below the U.S. in terms of births, in terms of total fertility rate. We're at 1.5. The U.S. is at 1.6, and replacement is 2.1. So we're way below replacement in terms of our birth rates. We're also seeing deaths increasing because simply we're becoming older. So we get a higher death rate. Migration. So migration to Colorado is actually slowing pre-pandemic. We are forecasting it to return to kind of the 2019, 2018 levels. But we've seen that it declined during 2020 and 2021. We're expecting it to come back, but some of the pieces include international migration. International migration fell to almost zero. and that accounted for about 22 to 25% of our total net migration to the state. So that's a big component. Our J1 worker visas fell from 10,000 to 1,000. So that's a big impact in terms of migration. So hopefully we'll see those come back as well. And a lot of times those provided services a lot of times provided workers to different services in our leisure and hospitality industry that are so critical for the state. Where do we think they're going to traditionally come from in the future? Where they come from in the past? California, Texas, Florida, New York. Those are big donor places, as well as Illinois. Big question, I think, is going to be that whole work from anywhere. How will that impact Colorado's growth? Or will they take that wage from Colorado and maybe move to Kansas? No, they wouldn't do that. What's to do in Kansas? Nothing. But I think that it's a concern because we are a higher cost state. We've got the 5th highest median home value in the country. Will we be able to continue to attract and retain? I definitely think we'll see activity from part-time workers that live here part-time. We call them digital nomads. They fluctuate all over the place. So we'll see people, but they won't necessarily be able to count in our total population. We will get some full-time folks that will leverage Colorado. For example, we're lower cost than Illinois, or than Chicago for sure, than New York, from Florida. We could easily see people here, dual income families that can leverage that as well as like the rural parts of the state, I think, can leverage this work from anywhere. But I want you to know that this whole concept of work from anywhere or teleworking is not for everyone and not all of our jobs. A very small share, actually, of our total jobs can be done remotely. And I hear a lot of people making all of these grandiose plans to accommodate everyone that's teleworking, but really only about 11 to 12% can. And so please keep that in the back of your mind as well. So long run, what we're doing is forecasting Colorado to bounce back. We are forecasting net migration to get back to levels that we saw kind of in the mid 2010 to 2020s, primarily because we see jobs recovering and we see stimulus dollars that are going to do that. I've circled that area on the chart showing really a demand from retirees. As I mentioned before, about 500,000 folks forecast to age out of the labor force over the next decade. And that's a lot of people to replace. But a big question is, will those jobs all be replaced, or will those be mechanized, or will they be left vacant? What will happen to the retirees out there? But what you can see from this chart is that bouncing back through about 2025 and then slowing out into the future. You'll see the natural increase component, which is the blue piece, never getting back to levels that we saw in the 2000s, slowing down out into the future simply because we've got a smaller difference between our births and deaths. If we look at the state as a whole, we're still, though, forecast to increase to about 7.5 million people by 2050. So even though I'm talking about the slowing, it's really the slowing of the velocity of our growth that we're seeing out into the future, but still increasing by about 1.8 million between 2020 and 2050. Most of that growth along the Front Range. And some of our biggest growth areas are Larimer and Weld, as well as then our South Metro area of Colorado Springs and Pueblo, really driven more by Colorado Springs. Of that 1.8 million, a large share, about 400,000, 440,000 in this North Front Range area of that growth. If you look at growth rates, the fastest growth in our state we're forecasting for this north area. A lot of it actually will have to do with water access. So that's something that we're paying very close attention to this decade in terms of if we will actually see that enough water available for that growth out into the future. So I'm not going to go over the summary because Brandon or somebody else has the slide deck available and you can take a look at them because I've hit all of them. But I do want you to be aware that there are risks to that forecast. I think there's still a lot of risk in terms of the uncertainty of the pandemic. Certainly international migration is a big component. Will it come back? Will there be a national international migration policy? Water, housing, and aging, I think, are some of the top 5 areas for us to be concerned about, or at least know that there's a risk. So with that, I want to thank you guys so much for having me on your program tonight. Thank you very much, Brandon, for having me, and I will turn it back over to you. Thank you.
I'd like to say thank you to each and every one of you for spending some time and for trusting us as a source of information and real estate knowledge for Northern Colorado. I hope that you found this time valuable. I hope you've taken away a few things. And as always, if you want to follow along with some of these storylines, please reach out. We obviously send Publications Our Insider out, and we will continue to follow these trends and stories throughout the year for 2022. But thank you for tuning in. Thank you for your trust, and we hope that everybody has a great evening, stays healthy, and stays safe. Thanks for tuning in.